As you can see here, this is the so-called Kiddie tax, unearned income. Anyone under 19 can make up to $1,050 of unearned income tax-free, or up to $2,100 in unearned income, and pay 10% in taxes. Anyone under 19 that makes more than $2,100 of unearned income is taxed at their parents' highest income tax rate. The amount over the $2,100 is taxed amount. For example, if you own 833 shares of stock that pays 10 cents a share per month, you end up $83.30 per month dividend income. That's unearned income, which means you get just under $1,000 a year. Hence, you have no taxes owed. So let's take another scenario. For anyone under 19, you own 1,750 shares of that same stock that pays a 10 cent per share dividend per month. So every month you make $175 income, unearned income. That's $2,100 a year. You own 10%. And that $2,100 is $210. So I ended up making after taxes $1,890. Here's where the other part of the perfect comes in over. Suppose your parents make $62,000 a year. You make over $2,100, anything over, and is taxed based on your parents' taxable income. They have a 25% tax rate or 30% tax rate. You own 2,500 share stocks, for example. With that 10%, 10 cents per share dividend, you make $250 a month in unearned income. You make $3,000 total a year. You take that $3,000, subtract it from the $2,100 maximum, which means you have $900 that's taxed at your 25% or 35% of your parents, which essentially means that you're getting $200 in taxes, plus the 10% from the $2,100, so that's another $200. That's that $487.50 in taxes that you're going to owe on that $3,000. So you're going to have $2,512 net or yearly income. This works for any unearned income: interest, dividends, bonds, mutual funds, investment property income like rental income, anything like that. In effect, if your child's income is about the standard deduction amount, but about $1,050 as of this time, anything over the $2,100 in unearned income is taxed at their parents' tax rate, 25, 35%, whatever it is. So anything over $2,100 is taxed at 25 or 35%. Generally speaking, anything over $1,050 to $2,100 is taxed at 10%. Anything over that, $2,100, is taxed at their parents' rate. So if your child makes $3,000, like I said above, you get $3,000, and that $2,100 tax, it's $210. Why you want to use it, obviously, is because it reduces your parents' overall tax if you're careful. But you can only reduce that tax so much, of course. And there you have the idea that your kiddie taxes, so to speak, is something that can help you as your child learns and grows. It can help the parent as well, but it can help the child to sit there and say, okay, how can we do this? How can we understand the investing? And that's something that you can help your child to understand, how they can reduce their taxes, how they can make money that they don't have to physically go out and work for, but they also save tax income. They have their money that they have that they can use without all that labor and just using their mind instead of the brawn always. And there you go. Go on to the next lecture, and hope you have the interesting time with it. Thank you.